It's time for another How to Beat the Banks weekly Fast Fact. Hey, I'm Joe Miller with this week's How to Beat the Banks Fast Fact. This week we're getting down and dirty with something that sneaks into our monthly mortgage payments and a lot of us don't even realize it. I'm talking about PMI, private mortgage insurance. Now, what is the concept behind this and why are the banks forcing us to pay it? Well, basically, typically if you're putting less than 20% down, the banks force this on you because it protects them in case you default or stop paying on the loan. It's kind of like their version of gap insurance for a car, but at least when you buy a car, the gap insurance protects you. When you do a home loan, the PMI protects the banks. When we're talking about PMI, we're referring typically to conventional home loans that are backed by a bank, conforming loans backed by a bank, not. But typically, conventional loan is for higher credit score borrowers. It could be a first-time home loan or a second-time or 50th-time home loan. Now, here's an interesting fact about conventional home loan. Once you have 20% equity, the private mortgage insurance automatically falls off. So let's say you bought a home for $200,000. We're talking hypothetical. We're not talking local real estate prices. And you put 5% down, which is $10,000. So you only have put 5% down on the loan. But 2 years later, because market and prices of homes have gone up so much, your home's worth $280,000. Well, now you have over 40% equity in the home, so that can come off. All you got to do is call the bank and go through the process to have the private mortgage insurance removed. They'll evaluate and assess the property to see what it's worth, and they'll take it off, which can seriously and dramatically lower your monthly payment. If you need help with this process, feel free to reach out to me. It's Joe Miller, local mortgage expert, here at How to Beat the Banks, and also I'm working at Pathway Mortgage. You can call me 941-236-6649. That's 941-236-6649. Or go to howtobeatthebanks.com and just shoot us a quick email. We'd be more than happy to help walk you through that process of trying to get the bank to remove that private mortgage insurance. And this is only on conventional loans, not government-backed. We're going to get to that in a minute. But conventional, you can have the bank take it off. Now, here's something the banks definitely don't want you to know, and that's why you listen to How to Beat the Banks here with me, Joe Miller. I'm going to tell you how to not have any private mortgage insurance on your loan, even if you don't put 20% down. So there's something called single premium pay. That means instead of paying until your mortgage hits 20% equity, which could be 1 year, it could be 5 years, depending on how the market's going, you can actually pay the PMI totally off in the front of the loan when you close and buy your home without putting 20% down, especially if you have a credit score over a 700. So that's the key with the conventional and not having PMI and not having 20% down is you definitely want to have better than average credit. I would say at least a 690 to a 710, somewhere around there, because that's going to determine how much the single premium pay. Because let's be honest, it's actually insurance. You're buying insurance to protect the banks. So you can go to the bank when you're doing your mortgage, and you could say, hey, I don't have 20% down. I don't want to pay PMI because it's a total waste of money. What can I do? And the answer is single premium pay. Now, this is determined on how big the loan is. So the larger your loan amount, the more your single premium payment's going to be. And the better your credit score, the lower your single premium pay is going to be. So if you have a high credit score and a lower loan amount, you're going to have a much lower amount to pay off to get rid of PMI. So let's talk averages. So if you have a 700 FICO and you're buying a home for $300,000 and you put 5% down, you could pay the single premium, you could pay your PMI off in the front of the loan for about $5,800. It depends on what private mortgage insurance company. Now, I'm going to say that again. It depends. Don't hold me that, but let's just say averages. I'm giving you a pretty good window of what it would look like. Let's say around between $5,400 to $6,200. However, so you don't have any PMI, you put 5% down plus an extra $6,000. That's a heck of a lot cheaper than putting 20% down. That saves you a ton of money. So if you buy a $300,000 house, put 20% down, that's $60,000. However, you put 5% down on a $300,000 house. Let's do the number. I'm going to put it on my calculator. 300,000. I'm actually using my iPhone times 0.05. That's 15,000 plus the 6,000 to pay off the single premium PMI. That's only $21,000 versus paying $60,000 for 20% down. So that's saving you $39,000. So make sure you call me, Joe Miller. I'll keep teaching you how to beat the banks, how to save money, how to keep more in the markets and not to the banks to pay PMI and other crazy things that come into effect when you're doing a mortgage. That concludes this week's Fast Fact. Tune in next week when we talk about mortgage insurance premiums, which is kind of similar to PMI, but a little different. You'll hear more about that next week.